We've crossed into territory that defies logic. Over the past 2 days, we've been examining market indicators. We studied the plunge to $86. We examined the closure of the U.S. Mint facilities. We analyzed the $13 markup in Shanghai. These served as indicators. They represented warning signs revealing that a blaze was raging somewhere within the depths of our financial infrastructure. However, this Saturday, January 18th, 2026, speculation is spreading that indicates the blaze exceeds everyone's expectations. We're examining a deeply disputed, unconfirmed document that's been spreading rapidly through institutional trading floors since morning. This ledger allegedly reveals the concealed short positions held by the world's biggest financial institutions. Holdings that remain hidden within the derivatives market, traded over the counter, and don't show up in official regulatory filings. And the figures shown in this document aren't merely concerning, they're catastrophic. Based on these disclosed projections, two major American financial institutions, Bank of America and Citigroup, might be carrying a total net exposure of approximately 4 billion ounces in silver. Allow me to emphasize that figure because its magnitude seems almost unbelievable. 4 billion ounces. We need to exercise caution. The official commitment of traders document indicates a short exposure around 500 million ounces. That's already enormous. However, if these revelations prove accurate, if the institutions have concealed an additional 4 billion ounces through off-book derivatives, then the silver market's mathematics are fundamentally shattered. To grasp why this represents a fatal blow to these organizations, you need to comprehend the tangible facts of silver markets. The worldwide mining sector, every extraction site in Mexico, Peru, China, Russia, and Australia together, yields roughly 800 million ounces of silver annually. That represents the absolute limit. We can't manufacture more, we can't extract it quicker. Calculate the implications. If worldwide output stands at 800 million ounces, and these institutions have supposedly sold 4 billion ounces, they've essentially sold 5.5 years of complete global production. They've sold silver that hasn't been extracted yet. They've sold silver that won't emerge from the earth until the year 2031. This represents the classic example of an uncovered short. They've sold a commitment they're physically unable to fulfill. In standard markets, a short seller obtains an asset, liquidates it, and anticipates repurchasing it at lower prices. However, for this to work, the asset must be available. You need to locate it. How will Bank of America and Citigroup locate 4 billion ounces of silver? They won't find it at the COMEX. The available inventory sits at 120 million ounces. They won't find it at the U.S. Mint. The Mint has halted transactions. They won't find it in London. The storage facilities are depleted. Whether the figure is 500 million or 4 billion, they're confined in a numerical trap of their own creation. This accounts for the turbulence we witnessed on Thursday. Recall the rapid decline? Recall how prices fell from 90 taus to $86 within minutes? The press claimed it was profit realization. The press claimed it was a technical adjustment. They were probably deceiving you. That decline resembles precisely a frantic, survival-driven effort to control an obligation that's expanding beyond control. Each dollar increase in silver price causes a short exposure of 4 billion ounces to lose $4 billion. When silver climbed from $50 to $90, if these stories hold truth, they lost approximately $160 billion in theoretical value. This explains why they crushed the price. They weren't attempting to profit. They were attempting to halt the hemorrhaging. They were attempting to avoid a margin demand that would destroy the institution. However, here lies the challenge with an uncovered short of this scale. It generates a vacuum in the marketplace. Because they've sold 5 times beyond what exists in yearly production, they've generated a future requirement that's 5 times bigger than future availability. Eventually, they must close these exposures. They must repurchase the agreements. From whom will they purchase them? Will they purchase from you? Will they purchase from Samsung? Will they purchase from the Chinese authorities? Nobody's liquidating. This explains why prices rebounded so rapidly. The market understands that the short exposure, whether official or concealed, actually represents future purchasing pressure. Every short exposure is a confirmed future purchaser. Bank of America isn't a vendor of silver. They're a confirmed purchaser of silver. They simply haven't purchased it yet. This understanding reverses the complete perspective. We're not observing a market that's overextended. We're observing a market that's oversold to a level that's unprecedented in financial history. If the concealed leverage proves real, we're observing a short exposure relative to yearly output of 550%. Consider this against the Volkswagen squeeze of 2008. In that squeeze, the short exposure was roughly 12% of available shares and prices increased 500% in one day. Consider it against the GameStop squeeze. The short exposure was 140% and prices increased 1,000%. We're observing a potential short exposure that eclipses anything previously witnessed. The potential force stored in this trade is atomic. And this leads us to the counterparty danger. If you possess a paper agreement for silver on the COMEX, who stands on the opposite side of that transaction? Who committed to provide that silver to you? It's probably one of these enormous institutions. If they're obligated for billions of ounces, and they only possess access to perhaps 50 million ounces in their storage facilities, they're bankrupt. They can't provide. This indicates that the millions of individuals possessing paper silver are possessing an agreement with an insolvent entity. They're possessing a commitment from someone who can't honor it. This explains why the tangible price is separating. The tangible market suspects that the paper market is fraudulent. When merchants charge $120 for a coin, they're incorporating the danger that the institutions will collapse. They're incorporating the fact that the paper agreements are valueless because the metal isn't available. We've dedicated years discussing manipulation. We discuss spoofing. We discuss suppression. However, this disclosed information alters the dialogue. This isn't merely manipulation. This is irresponsibility on a magnitude that endangers the foundation of the complete global financial infrastructure. These institutions have supposedly risked everything against silver, and silver is prevailing. In the following section of this comprehensive analysis, we're going to determine the bankruptcy figure. We're going to take the present price of $90, multiply it by this speculated short exposure, and demonstrate the deficit in their financial statements. We're going to compare that figure to the complete equity of these institutions. And we're going to demonstrate why the Federal Reserve will have no option but to step in. However, they won't step in by locating more silver. They will step in by creating more dollars. The mathematics are catastrophic. The obligation is definite, and the timer is running. We have outlined the foundation based on the disclosed information circulating through institutional platforms that Bank of America and Citigroup may be maintaining a combined concealed short exposure of 4 billion ounces of silver. Now we must perform the calculations that the mainstream press is too frightened to perform. We must determine the mark-to-market destruction. We must measure the breach in the vessel's hull. Consider the present price of silver. Let's use $90 per ounce to simplify the calculations. Multiply $90 by 4. 4 billion ounces. The outcome is $396 billion. Allow that figure to register. $396 billion. This isn't a trading setback. This isn't a disappointing quarter. This is a solvency crisis. To place this figure into context, let's examine the market value of these institutions. The market cap represents the complete value of every individual share of stock the institution has distributed. It's what markets believe the complete company is valued at. Citigroup has a market cap of roughly $120 billion. Bank of America has a market cap of roughly $260 billion. If you combine them, the combined market cap is approximately $380 billion. Do you recognize what this indicates? The loss on the silver short exposure is bigger than the complete worth of both institutions together. They couldn't absorb this loss even if they liquidated every single asset, terminated every single employee, and shut down every single branch. The loss exceeds their combined existence. This isn't a scenario where they report reduced earnings. This isn't a scenario where stock prices decline. This is a scenario where the institutions disappear. However, the situation deteriorates because these institutions don't function independently. They're interconnected through derivatives with every major financial institution globally. If Bank of America or Citigroup declares bankruptcy, the contagion extends to JP Morgan, to Goldman Sachs, to Deutsche Bank, to HSBC. The complete derivatives market, valued at roughly $600 trillion in theoretical value, begins disintegrating. One institution collapses and drags 12 others with it. This is what authorities describe as systemic danger. This is what central banks have nightmares about. This is why the Federal Reserve, whether they acknowledge it or not, is monitoring this circumstance with absolute terror. Because they understand that if the silver short explodes, it doesn't merely destroy two institutions. It destroys the infrastructure of the dollar-based financial system. So why hasn't the Federal Reserve stepped in yet? Why haven't they organized a rescue? Because they're calculating. They're assessing the political cost versus the financial cost. A rescue of this scale would require perhaps $500 billion in freshly printed dollars. It would require the Federal Reserve to essentially confess that the derivatives market is fraudulent. It would require them to confess that the price of silver has been artificially suppressed for generations. And that confession would trigger universal loss of confidence in every paper market. Gold would explode. Bitcoin would explode. Treasury bonds would collapse. The dollar would plunge. So they're delaying. They're hoping the circumstance resolves itself. They're hoping that silver holders panic and liquidate. They're hoping that physical demand decreases. However, the exact reverse is occurring. Physical demand is increasing. The Shanghai premium is expanding. The U.S. Mint remains shut. And every additional day that silver remains above $85, the institutions lose billions. This is why we're witnessing what we're witnessing. The crash on Thursday wasn't random. It was coordinated. Somebody with enormous capital decided to liquidate hundreds of millions of dollars worth of silver contracts in seconds. They weren't seeking profit. They were seeking to trigger panic. They were seeking to induce stop-loss orders. They were seeking to shake out the weak holders. However, it didn't succeed. The price recovered. And now they're in a more desperate position than before, because the market comprehends what occurred. The market recognizes a capitulation attempt when it observes one. And rather than fleeing, purchasers returned. Rather than panic selling, we witnessed panic purchasing. This is the indication of a squeeze. When the institutions attempt to suppress the price and the market purchases the decline, you understand the institutions have lost authority. They've lost the ability to control sentiment. And when they lose control, they lose everything. So let's discuss what occurs next. Let's discuss the timeline. We're currently at $90 per ounce. If the institutions can maintain it below $100 for another month, they might survive. They might discover a method to move their positions into longer dated contracts. They might discover a method to disperse the loss over time. However, if silver breaks above $100 and remains there, the institutions are finished. At $100, the loss becomes $440 billion. At $110, it becomes $484 billion, nurse. At $120, it becomes $528 billion. Each $10 increment represents another $44 billion in losses. And at a certain threshold, likely around $120, one of these institutions will declare bankruptcy. They'll declare that they can't fulfill their obligations. They'll trigger a force majeure clause. And when that occurs, every paper contract becomes questionable. Every futures agreement becomes a legal dispute. Every ETF becomes a potential fraud. The complete paper silver market, which represents roughly 90% of all silver trading, collapses overnight. And the physical market, which represents 10% of trading, becomes the only genuine market. This is the supercycle that Samuel Benner predicted 150 years ago. Benner was a farmer and amateur economist who developed a cycle theory based on commodity patterns. He created a chart that forecasted commodity peaks and valleys decades in advance. And according to his cycle, we're currently positioned at a major turning point. The last major commodity peak was 2011. Silver reached $49. Then we entered a 14-year bear market. Prices declined. Miners went bankrupt. Production facilities closed. Everyone forgot about commodities. However, according to the Benner cycle, 2024 through 2026 represents the reversal. This is when commodities bottom and begin a multi-decade bull market. And the catalyst for this reversal, according to Benner, is always the same. It's not demand. It's not inflation. It's the collapse of the short sellers. When commodity prices remain suppressed for too long, the short sellers become complacent. They increase their positions. They become overconfident. They believe they control the market. However, they don't control supply, and eventually supply becomes scarce. And when supply becomes scarce, the shorts are destroyed. This is precisely what we're observing with silver. For 15 years, the institutions have been shorting silver with impunity. They've suppressed prices. They've prevented rallies. They've made fortunes. However, while they were shorting, the physical supply was depleting. Mines were closing. Refiners were reducing capacity. Industrial users were depleting inventories. And now, in 2026, the supply is exhausted. The vaults are empty, the institutions owe billions of ounces, and they can't locate them. The Benner cycle forecasted this exact circumstance. It forecasted that the reversal would be violent. It forecasted that the shorts would be liquidated. And it forecasted that the institutions that bet against commodities would be destroyed. We're not observing a normal bull market. We're observing a structural transformation. We're observing the conclusion of the paper era and the beginning of the physical era. For 50 years, since the United States abandoned the gold standard in 1971, we've existed in a world where paper was dominant. Paper money, paper contracts, paper promises. However, that system only functions if everyone believes the paper. And belief is vanishing. The Chinese don't believe the paper. That's why Shanghai has a $13 premium. They're paying extra for physical delivery because they don't trust the COMEX. Industrial users don't believe the paper. That's why they're securing supply agreements directly with mines. They're bypassing the exchanges because they don't trust the delivery mechanism. Retail investors don't believe the paper. That's why coin dealers are charging $30 premiums. They understand that the official price on the screen is fictional. When belief collapses, the paper system collapses. And we're observing belief collapse in real time. Every day, more individuals realize that the institutions can't deliver. Every day, more individuals demand physical metal. Every day, the separation between paper and physical expands, and this separation is irreversible. Once investors lose confidence in a market, they never regain it. Once they realize they've been deceived, they never return. The paper-silver market is experiencing a crisis of legitimacy, and crises of legitimacy don't resolve themselves. They culminate in revolutions. We're not merely observing a short squeeze. We're observing a revolution. We're observing the masses reject the institutions. We're observing individuals reclaim control of their wealth. When you purchase physical silver, you're not merely making an investment. You're casting a vote. You're voting against the institutions. You're voting against manipulation. You're voting for genuine value versus paper promises. And millions of individuals worldwide are casting the same vote. This is why the institutions are terrified. This is why they're attempting to suppress the price. This is why they're utilizing every tool available. However, they're losing, because you can't suppress supply and demand forever. You can't short a physical asset that's disappearing. You can't print silver. You can't create it from nothing. And when the institutions run out of metal to deliver, when the vaults are completely empty, when the last coin is sold, the game concludes. The price on the screen becomes meaningless. The institutions declare force majeure, and physical silver holders name their price. This isn't speculation. This is logistics. The numbers don't work. The institutions owe more silver than exists, and mathematics doesn't negotiate. So what's the timeline? When does this climax? Based on the present evidence, we're estimating 6 to 18 months. By mid-2027, either the institutions discover enough physical silver to cover their shorts, which is mathematically impossible, or they default. There's no third option. The institutions can't print silver. They can't negotiate with physics. They can't alter the fact that 4 billion ounces doesn't exist. So they'll default. And when they default, the paper market terminates. And when the paper market terminates, physical silver becomes the most valuable commodity on Earth, because it's the commodity that everybody needs and nobody can obtain. This is the essence of a supercycle. It's not merely a price increase. It's a paradigm transformation. It's the moment when a commodity transitions from being traded to being hoarded. When silver was $20, individuals traded it. When it's $200, individuals will hoard it. And when individuals hoard a commodity, the price becomes infinite. Because at a certain threshold, the holders stop selling. They recognize that the asset is more valuable than whatever currency you're offering. They recognize that silver represents real wealth and dollars represent paper. This is the psychological transformation that destroys markets. When holders become believers, when traders become investors, when investments become religion, we're observing the early stages of this transformation now. Observe the forums, observe the social media, observe the passion. Individuals aren't discussing silver like a trade. They're discussing it like a cause. They're discussing it like a movement. This is the psychology that generates super cycles. This is the psychology that generates manias. However, this mania is based on reality. Because unlike tulips or beanie babies, silver has genuine utility. It's required for solar panels, it's required for electric vehicles, it's required for electronics, it's required for medicine, it's required for weaponry. Silver isn't optional, it's essential. And when something is both essential and scarce, price becomes irrelevant. You pay whatever necessary. This is what the institutions don't comprehend. They believe silver is merely another commodity. They believe they can manipulate it like they manipulate everything else. However, silver is different. Silver is physical. Silver is finite. Silver is disappearing. And when it's gone, they're finished. The evidence is everywhere. The US Mint is closed. Why? Because they don't possess metal to strike coins. The Shanghai Premium is $13. Why? Because China is hoarding physical delivery. Dealers are charging $120 for coins that should cost $90. Why? Because they can't replace inventory. Refiners are quoting 6-week delays. Why? Because they're allocating scarce production. The wholesale market is freezing. Why? Because nobody wishes to sell. All of this is occurring while the official price is $90. Imagine what occurs when the official price is $150. Imagine what occurs when individuals comprehend that the institutions are bankrupt. Imagine what occurs when the force majeure announcement is made. The price won't gradually increase. It will gap. It will jump from $90 to $150 overnight, and then from $150 to $250 the following week. And then it will stop trading altogether because nobody will sell. This is the definition of a market that has become dislocated. When prices move faster than information, when supply vanishes faster than demand can adjust, when the systems that are supposed to facilitate trading begin preventing trading instead, we're observing the beginning stages of this dislocation currently. The price volatility on Thursday was a symptom. The crash to $86 and the recovery to $92 within hours was a symptom. The expanding premiums were a symptom. The closing of the mint was a symptom. These aren't isolated events. They're related. They're all pieces of the same puzzle. And the puzzle depicts a market that's breaking, not bending, breaking. The institutions recognize this. That's why they're attempting to suppress the price. That's why they executed the flash crash. They're attempting to purchase time. They're attempting to discover an exit. However, there's no exit. They're trapped. And the more they struggle, the tighter the trap becomes. Every attempt to suppress the price generates more purchasing. Every attempt to shake out holders generates more conviction. Every attempt to delay the inevitable makes the inevitable worse. This is the paradox of a short squeeze. The shorts can't escape without purchasing. However, purchasing increases the price, and increasing the price increases their losses. And increasing their losses makes them more desperate. And their desperation makes them do irrational things, like crashing the price by $6 in minutes, like declaring force majeure, like requesting government rescue. These are the activities of institutions that understand they're finished. These are the activities of institutions that are drowning. And when institutions drown, they grab for anything nearby. They'll grab for your physical silver. They'll offer you $90. They'll offer you $100. They'll plead with you to sell. However, if you sell, you're rescuing them. You're providing them the oxygen they need to survive. Don't rescue them. They created this circumstance. They shorted 4 billion ounces of silver that doesn't exist. They gambled that you'd never demand delivery. They gambled that the paper system would last forever. However, they gambled incorrectly. The paper system is concluding, the physical system is starting, and in the physical system, he who possesses the metal possesses the power. You possess the metal, you possess the power, don't surrender it. The institutions will attempt to convince you that the price is elevated. They'll utilize terms like overbought and correction and fundamental value. Ignore them. There's no such thing as fundamental value in a market that's breaking. There's only supply and demand, and supply is zero. When supply is zero, demand doesn't matter. Price doesn't matter. Only possession matters. If you possess it, you have everything. If you don't possess it, you have nothing. This is the brutal reality of commodity markets. This is the reality that the institutions comprehended too late. They believed they could short silver indefinitely. They believed paper was equivalent to physical. They believed numbers on screens were equivalent to bars in vaults. However, they were incorrect, and their error is about to cost them everything. Meanwhile, you, the physical holder, are positioned perfectly. You possess the asset that the institutions owe. You possess the asset that industries require. You possess the asset that governments desire. You possess leverage, genuine leverage, not paper leverage, not derivative leverage, physical leverage, the leverage of scarcity, the leverage of necessity, the leverage of reality. And reality always defeats paper. Always. The institutions can manipulate prices. They can manipulate sentiment. They can manipulate media. However, they can't manipulate physics. They can't create silver from nothing. They can't alter the fact that their vaults are empty. They can't alter the fact that they owe 4 billion ounces. They can't alter the fact that they're insolvent. The mathematics is absolute. The obligation is absolute. The conclusion is absolute. They'll default. And when they default, you'll prosper. Not because you're fortunate, not because you speculated correctly. However, because you comprehended the game. You comprehended that paper is fraud and physical is truth. You comprehended that institutions lie and mathematics doesn't. You comprehended that scarcity creates value and abundance destroys it. You comprehended the fundamental principle of wealth. Own what others need, control what others desire, possess what others can't obtain. You possess silver. The institutions require it. The conclusion is predetermined. The only question is the timeline. And based on everything we're observing, the timeline is accelerating. The institutions are running out of options. The vaults are running out of metal. The market is running out of patience, and the cycle is turning. The Benner cycle forecasted this moment. The leaked ledger confirmed the victim. The force majeure will deliver the final strike. We're witnessing the termination of the paper derivative market in real time. Welcome to the commodities supercycle. We've reached the conclusion. If you've followed me through this complete forensic examination, you now grasp the frightening magnitude of the trap the institutions have constructed for themselves. You grasp the impossible mathematics of the 4 billion ounce short exposure. You grasp the insolvency equation that threatens to eliminate the equity of the Western financial system. And you grasp the Benner prophecy that forecasted this precise moment in history over 150 years ago. The evidence is overwhelming. It's not speculation. It's a mathematical certainty. We're not observing a trading adjustment. We're not observing a standard market cycle. We're observing the conclusion of the paper derivative market as we understand it. So how does this conclude? How do the institutions escape a $390 billion obligation when they don't possess the metal to cover it? They don't purchase the metal. They don't provide the metal. They declare force majeure. This is the legal terminology that has been discussed in the back offices of the commodities market for weeks. It's a French phrase that translates to superior force. In contract law, it's the emergency exit. It permits a party to violate a contract without penalty if they're prevented from fulfilling it by circumstances beyond their authority. Usually, force majeure is reserved for acts of nature, hurricanes, earthquakes, conflicts. However, in the approaching days or weeks, we believe the bullion institutions will attempt to use it to describe the extraordinary market circumstances that they generated. They'll assert that the Shanghai squeeze, the retail accumulation, and the supply chain interruptions have made it physically impossible to provide the silver they're obligated for, and they'll activate the cash settlement provision. Every futures agreement on the COMEX has fine print, and that fine print states that if physical provision cannot be made, the exchange possesses the authority to settle the agreement in cash. This is the nightmare situation for the paper holder.